You've hit a pause button and that's about it. I will not use the word that, oh, it's the reversal, it's end of the bull market. For me, this is a simple pause. And I think that is evident in the way how things are stacked up. 3 weeks of decline optically may look large. But in the same time, if you look at the mid and the small cap stocks, they've not done that badly at all. So I will not read too much into the price setup. But my sense is that if you're a Nifty watcher for the first time after a gap of almost 3-4 months, the real support of the market would be tested. Up until now, on the way down, the support of the market has not been tested. Bulls have never had even a wrinkle, so to speak. The market rally has been so linear. But we are in that phase of the market where the bias is not up, the bias is down. And in a downward bias, on the way down, the support now for the first time on the Nifty would be tested. You look at the FNO positioning, FIs, they were June, 70% long, 30% short. Now it is 40-60. So that is just telling you the bias also of the market. So for the first time in the summer rally of 2023, in a sense, would be has lost its sheen and shine. And if you are a long trader, well, you got to watch yourself now, because if you go below the key support levels on the Nifty and on the Bank Nifty, then in the near term, a air pocket cannot be ruled out.
Yeah, and the FII figures as well haven't quite turned positive. In fact, Friday's figure is a mammoth 3,000 crore rupees.
So, it's more like a global phenomenon, which is what I was looking at. So you can look at Friday's data in isolation, but if you have to look at the data, at least for the month of August, that's a reasonable time frame to look at the data. That's the stack. It's a lot of red now. But compare that with what has happened to other emerging markets and compare that with where India stands in terms of the global positioning. So the outflows, I think, are a function of what could be called as a China versus rest of the emerging market trade. And it is empirically evident in the way how other markets have shown outflows. Taiwan, Brazil, Indonesia, Thailand, and India. India is still net positive. And I don't expect that the global selling, which has started because of interplay between the dollar index and what is happening to other emerging markets, India will be hit the least. But flows are flows. They decide the short-term and the near-term market direction. Flows are threatening to reverse. If they reverse, of course, it will have implications on the market. Now, the trade for rest of the August and for next couple of days could be, will it be China versus rest of the world? Because China seems to be humming back. So from the global market standpoint, that now really becomes the trade, that what we saw at the beginning of the year, where money moved into China, it came out of other emerging markets. Will that trade be revisited? It's, nobody's made money by investing in China, but कहते हैं ना जिद होती है. It's just one of those things where you are again and again tempted to go back to China because the valuations are so attractive and the market has underperformed for so many years that optically it gets difficult to justify allocating more money to India, because you know that India is the only game in the town right now.
Yep, so we'll have to see how that trade really pans out. But let's also take note not of just the China picture, but how things have shaped up overseas, particularly on Wall Street. And yes, August has started off with a bit of a rough start. S&P 500 as well as the Nasdaq, that continues to lose for the second straight week on the trot, really finding it difficult to sustain that rally. And that's not just it. Individual talking points as well. The 10-year bond yield, that has surged to about 4.16%. You've got crude oil prices. Remember, it's been 7 straight weeks that you've seen an uptick in crude oil prices, and that's largely on the back of the OPEC Plus output cuts and even concerns about China's economy and the stronger dollar. The dollar index actually has risen for 4 straight weeks on the trot. So what exactly does that spell out, Nikunj, in terms of the global setup?
No, one look globally, what would I monitor in the short term? I would be monitoring 3 things. Number 1, the bond yield movement. 4.1, anything above 4, you will be uncomfortable with the directional the bond yield has taken. Second, you would look at the way how in the near term Nasdaq would move. Nasdaq is the performing index. If performing market reverses, AI, chip makers, if they start reversing, then you got to say yourself, is the global rally getting over? Third, this week per se, you got a lot of data. Third would be commodity prices. largely because crude is at a 15-week high, almost a 3-month high. Other commodity prices have also started moving higher. So frankly, if you're looking at this, if you're looking at the near-term indicators for the market, the near-term market direction will not be a function of value. It will not be a function of earnings. It will be a function of macros and technicals. The macro setup, like I explained, is looking slightly puffy-duffy. Commodity prices have started moving higher and the bond yield is at 4% plus and Nasdaq is threatening to reverse. If we don't see any more sizable downside, which is crude starts declining or starts peaking out, Nasdaq stabilizes, then this would just be passe now. But I get a sense looking at the screen and when I spoke to folks and some of the old timers that we could be in for a very dull and a boring August with a downward bias, and the bias is something which needs to change. So the free flowing market where you would come today and sell tomorrow and when buy today, forget tomorrow, you but buy in the morning and sell in the evening, or you but buy at 9:30 and sell by 11:30, that free flowing market, I think that is what our viewers they need to understand, that free flowing market is no longer at play. The playbook of the market for a trader has changed.
Yeah.